Hi friends, good morning and welcome back. So from today we're starting our series on assessments and assessment procedures under the existing income tax law. And we would be starting off with summary and scrutiny assessments at the high level, more to look at what are the legal provisions and also a brief overview of the return filing process under income tax. I would like to thank Bharti, Thirumal and Jugal for getting this presentation in place. These are some of the terms used. I'm sure most of you are familiar with these, but just in case of reference. Yes, this is where we would start off with the types of return, the due dates, types of assessments, and what actually happens in summary, and then what happens in scrutiny assessment, what is the scope, what is the time limit for completion, then how the process of notice of demand happens, the e-assessments which has been introduced, which is likely to become a reality effective next month, and of course appeals and rectification mechanism and assessment procedures in other countries. So we're not getting in detail into appeals and process at this point in time. Moving forward, assessment. So every taxpayer or every person who's supposed to pay or file income tax returns is expected to do so within the due date available. And once a return is filed, there is a possibility for every return will effectively be regarded as self-assessed by the SSC, and moment the assessment acknowledgement of return is provided, it is deemed to be an assessment. However, which is under 143(1), the acknowledgement will be regarded as a summary assessment. However, the department also has the option as well as the right to make certain additions under both summary assessment as well as scrutiny assessment as they move on. There are, of course, certain other types of assessments like best judgment, income escaping assessment, search assessment, seizure survey, which we are not getting in at this point in time. What are the types of return? So we have section 139, which deals with return of income. So types of return, first is 139(1), which talks about due date for filing return. 139(3) talks about loss returns. 139(4) belated, and 139(4)(c) returns to be filed by exempt entities which are eligible for exemptions under section 10. 139(5) is revised return. 142(1). So 142 technically as a section talks about inquiry before assessment, and 142(1) deals with a notice which can be sent by the income tax department for filing a return of income. So that's the brief overview as far as 139 is concerned. Due dates for filing return of income for SSC, for corporate SSCs which are eligible to do audit under income tax or under any other law, which typically, all your company SSCs, tax audit cases, the due date is 30th of September. And those SSCs who are liable for transfer pricing, the time limit is 30th of November. And for every other SSC, it is 31st of July. Now, types of assessments: summary assessment, scrutiny assessment, best judgment assessment, and income escaping assessment. So today our scope of engagement would be only 143(1) and 143(3) at this point in time, summary and scrutiny assessment. So summary assessment, so as the name itself suggests, it is not a very detailed assessment. It is so the preliminary assessment can be done without calling the SSC. And summary assessment is checking the return of income at the high level. It can be done for both return filed under 139 or in response to a notice under 142(1). Summary assessment, detailed scrutiny of return of income. Again, when we say it is all done on the macro parameters, they don't get into individual items. The time limit for summary assessment is 1 year from the end of the financial year in which the return of income is filed. So it is 1 year from the end of the financial year. So for the financial year which is ending March 20, the time limit will be 31st of March 2021. Okay. Again, we're talking about 1 year from the end of the financial year, friends. So in summary assessment, what are the adjustments which can be made? Any arithmetical error can be rectified. Any incorrect claim, if it is apparent, can also be rectified, will be disallowed. Any disallowance of losses claimed if the return of income for the previous year was furnished beyond the due date. Because one thing which we will see, friends, under 139(3, as loss return has to be filed within the due date prescribed into the income tax law. So where you have not filed the return or you have filed it beyond the due date, you will not be eligible to claim the losses under the provisions of income tax law. But if you have filed it belated and you claim the benefit of loss in your return, then that claim of loss could be disallowed. Disallowance of expenditure. So if a tax audit report says, let's say there's a section called 40A1A which talks about deduction and payment of TDS for expenses within the due date under income tax return. Now, if you have not filed it or if you have not paid TDS on time and your tax auditor has qualified it in the report, then that could be a case for disallowance. Disallowance of deduction under Chapter 3 or Chapter 6A if the return is filed beyond the due date, because both SEZ 10AA and special incomes 80IA to 80IE categorically states that return of income has to be filed within the due date for providing these benefits. Addition of incomes appearing in Form 26A, which is your TDS return form, Form 16A and Form 16, which has not been included. However, no such adjustment shall be made in relation to assessment to a return furnished for assessment year 18-19 or thereafter, because we've had amendments to the respective provisions. And also what happens now is your TDS credits automatically get picked up from your Form 16 and Form 16A and 26As. Further, what we are also given to understand in present as return forms is all the liabilities due and received as well as payable to third parties are automatically the data is captured within the system, and the automatic scheme of mapping is now being pronounced with at this point in time. It's, as we would have heard the finance minister say, we are focusing more on pre-filled returns. So the era of transparency is only getting expanded. Incorrect claim and a claim apparent from any information in the return means a claim on the basis of an entry in the return which is inconsistent with another entry, in respect of which the information required under the Act has not been fully furnished, or if it's a deduction where the deduction exceeds the statutory limit. So either of these, classic example, house property, 2 lakhs is your limit and you have claimed 4 lakhs. Automatically, this becomes a case for incorrect claim. But as things are stand by, friends, with the extent of automation which is happening, most of these provisions are already built into the system itself. So if the limit is threshold is 1.5 lakhs for Chapter 6A or 2 lakhs for Chapter 6A, you cannot claim more than 2 lakhs under Chapter 6. So now that's how technology is trying to minimize the possibility of these instances. So once we have the aforesaid adjustment shall not be made unless an intimation. So if the department finds a case where there is an incorrect claim or an excess claim or a deduction which is inappropriate, a notice, an intimation is sent to the SSC. Based on the response, a decision is taken by the assessing officer. Where no response is obtained for a period of 30 days, automatically it becomes a case for considering that transaction or the issue raised as acceptable by the SSC. So how does the process of summary assessment work? After computing total income or loss by providing for arithmetical error and incorrect claim, the interest, tax, if any, or fee, if any, due shall be computed on the basis of the adjusted or the revised income. Any sum payable or refund due to the SSC after adjusting for advance tax, self-assessment, TDS, TCS, etc. shall be intimated. An intimation shall be prepared or generated. Today, most of this, by and large, this is automated. There is no human involvement at this point in time. Shall be sent to the taxpayer specifying the sum to be paid or to be refunded. An intimation shall also be sent to the taxpayer in case where loss is declared on the return by the taxpayer is adjusted, but no tax or interest is payable or refund is due. The acknowledgement of return of income shall be deemed to be an intimation in case where no sum is payable or refundable to the SSC. So fairly straightforward provision, friends. So you file a return of income, you receive an acknowledgement, it is an intimation under 143(1). Where you file a return of income, you've got the acknowledgement, but later within the time limit of 1 year from the end of the financial year, the department comes back saying no, certain things are missing. So in such cases, that will also be regarded as an intimation under 143(1), and you are expected to take action based on whatever is the outcome of the intimation. So if the intimation is expecting you to pay taxes, you are supposed to pay tax. If your refund is reduced, then the reduced refund shall be offered to you. Or where none of this happens and your loss is carry forward loss is reduced, that shall be the amount which you will be allowed unless you respond within 30 days of intimation. So this is as far as summary assessment is, friends. Next we move on to scrutiny assessment. When it comes to scrutiny assessment, as the name itself suggests, department scrutinizes. So they spend some more time under 143.3. Scrutiny assessment is a detailed assessment. In this, the return of income will be completely scrutinized. It is done to confirm the correctness and genuineness of various claims made by the taxpayer in the return of income. To carry out scrutiny assessment, the return must be filed under 139 or 142.1, same as your 143.1 summary assessment. The object of the scrutiny assessment is to ensure that, like the case for any assessment under income tax, the assessee has not understated the income, or has not computed excessive loss, or has not paid or underpaid tax in any manner. So the objective is threefold. Income should not be understated, loss should not be exaggerated, tax should not be underpaid. So the entire intent is to ensure that the revenue's interest is protected. So what is the procedure? Where the AO considers it necessary or expedient to ensure that the taxpayer has not understated the income, or has not computed excessive loss, or has not underpaid tax, which is a threefold objective, shall serve a notice to the tax assessee to attend the office to carry out scrutiny assessment under 143.3. The AO shall serve notice in accordance with the provisions of 143.2. So 143.2 notice is mandatory for an assessment under 143.3. Without the notice, 143.3 assessment cannot happen. What is the time limit for issuing notice? Within 6 months from the end of the financial year in which the return is filed. So it's a very shortened time frame. So, but look at it, friends. It is from the end of the financial year in which the return of income is filed. So we are talking about, so let's assume for the financial year 18-19, your due date is say 30th of September 19. So the time frame, the end of the financial year is 31st of March 20. So 6 months. So before September 20, your return can be picked up for scrutiny. The taxpayer or his representative will appear before the AO and will place arguments. And after hearing, he shall make an order and determine whether any sum is payable or refundable, or as the case may be. Denial of exemption in case of specified entities. In case of specified, so it's fairly straightforward. Before I'll just quickly summarize some scrutiny assessment. A notice under 143.2 is mandatory. This notice has to be issued within 6 months from the end of the financial year in which the return of income is filed. And once a notice is issued, a questionnaire generally follows. The questionnaire has to be answered, and based on the response, the department will come to a conclusion. However, an opportunity of being heard shall be made available to the assessee, and then the assessment gets fructified. So in case of specified funds or institutions, assessment shall not be made without giving effect to the provisions of Section 10, unless the AO has intimated the central government about the prescribed authority about the contravention. The approval granted to such entity has been withdrawn or rescinded. So if you look at the case of Section 10 entities, let's say the case of an educational institution or a university, or a charitable trust, there are cases where the income shall be exempt. So in case of such institutions, the assessment shall not be made without giving effect to the provisions of Section 10. So the assessing officer cannot just assess the income without considering the exemptions available under Section 10, except in circumstances where the institution has contravened the provisions of law and has made certain violations, in which case the approval granted has either been cancelled or withdrawn. Where the AO is satisfied that the activities are not being carried out in accordance with the conditions for approval, he may recommend the case for cancellation of the approval. However, an opportunity of hearing should be given to the assessee. The above two conditions shall not apply in the case of a trust or an institution whose objects for advancement of general public utility and its commercial receipts during the previous year has exceeded 20% of the total receipts from commercial activities. I'll quickly give you a brief background for this, friend. There's a section called 2 subsection 15, which talks about the definition of the term charitable purpose. So there are different, when we say charitable purpose, there are different circumstances in which a particular entity or an institution could be deemed to be engaging in charitable activities. It could be medical relief, relief for poor, education, yoga, wildlife preservation, environmental preservation, or any other object of general public utility. And there is also a provision where it says, if your receipts under any other object of general public utility exceeds 20%, then you might end up ceasing to be a case for, you may not end up being deemed as a fully charitable institution. But that's only an extraordinary circumstance. So what this provision says is, if you come under the exceeding 20% category, the AO need not necessarily write to the central government for cancellation of your registration, because it could be a one-off instance, in which case you are expected to pay tax on these receipts and the issue gets closed. It does not become a case for cancellation. That's the background of this particular exception being provided. Next, what is the time limit for completion? So any assessment obviously has to have a time limit. And if you look at a country like India, one of the biggest complaints against the ruling dispensation or any bureaucracy is the time taken for decision making. So as far as scrutiny assessment is concerned, the time frames have significantly come down over a period of time. And when we look at it, from assessment year 1920 onwards, it is 12 months from the end of the assessment year in which the income was first assessable. So let's say for the assessment year 1920, before March 21, the return of, the assessment has to be completed. If the reference is made to a transfer pricing officer, where the case involves a case for transfer pricing, then the time limit available gets extended by another 12 months, so which effectively means 24 months from the end of the assessment year for TP cases, or 3 years from the end of the financial year for TP cases. Every other case, it is 2 years from the end of the financial year. Next. So once the scrutiny assessment is completed and an amount is deemed to be payable by the SSC, then what happens? A demand notice after the scrutiny assessment order, demand notice is being issued to the SSC together with interest, tax, or penalty, as the case may be. If there is no demand notice under 156, 156 talks about recovery and demand and recovery. However, demand notice is not required for summary assessment, because in summary assessment, the intimation under 143.1 is deemed to be a notice for a demand under 156. Payment of demand or refund, demand payable under 143.1 or 143.2 must be paid within a period of 143.1 or 143.2 read with 143.3 must be paid within a period of 30 days. If it is not paid within 30 days, then the SSC shall be deemed to be in default. Penalty and recovery proceedings can be initiated. If there is refund, the refund has to be offered to the SSC. So let's look at it this way, friends. So a case has been picked up for scrutiny and a notice under 143.2 is issued within 6 months from the end of the financial year in which the return of income is filed. And then an assessment under 143.3 is concluded within 12 months from the end of the financial year in which the income was first assessable. And then comes the case for, once the 143.3 order is sent, it is simultaneously accompanied by a demand notice under 156. So if based on the order there is a tax payable, within 30 days it has to be paid. If based on the order there is a refund due, it has to be paid within 30 days by the department. Whether it actually happens or not, that's a different story altogether. But as far as the SSC is concerned, he is supposed to pay within 30 days, together with whatever is the interest and tax due and penalty, if any, as the case may be. Now, where the SSC fails to pay this due within 30 days, he or she or it can be regarded as an SSC in default, and automatically recovery and penal proceedings can be initiated against the SSC for non-compliance. 143.3. This is one of the most awaited scheme by the Parliament, which has been announced in the present budget. A scheme which is likely to completely change the way in which tax assessments are being carried out in this country. E-assessments. Now, before we get into e-assessments, friends, we'll try and understand how assessments currently happen in this country. So let's take the case of a scrutiny assessment, and 143 notice is issued together with a questionnaire. the representative of the SSC, invariably either a senior employee or the chartered accountant, goes to the SSC's assessing officer, meets the assessing officer, and then submits the information which is required. Then an assessment happens based on data furnished. A lot of allegations have happened in the past in terms of corruption, connivance, or various other practices which are not very advisable. To ensure that this case for human intervention is completely eradicated, the government actually did a pilot last year, if I'm not wrong, where they did e-assessment in certain specific jurisdictions where the outcome was considered to be commendable and successful. Given the success, the government is now officially planning to roll out e-assessments throughout the country. So how it is going to happen? E-assessments, as the name itself suggests, is going to be a faceless engagement where you no longer need an assessing officer, you need to meet an assessing officer. And the assessing officer, in all likelihood, may not be from your own jurisdiction. So sitting in Chennai, you could handle a case of an SSC living in Mumbai, and the case could be assessed by an SSC assessing officer in Delhi. Everything is very much possible. So as part of the e-governance initiative to facilitate assessment proceedings electronically, it has launched the e-proceeding facility. Under this initiative, it is made it mandatory for all tax officers to take recourse of electronic communication for all limited and complete scrutiny. CBDT has issued instructions and notice formats for conducting scrutiny assessments electronically. The finance minister has also publicly said at the end of last month that this will go live from Vijayadashmi, which is effectively from mid of October next month. And this is likely to completely eliminate the need for physical interaction and significantly optimize economies of scale, and also bring down corruption and inefficiency in the system. If this happens, this becomes a real reality, would be one of the most path-breaking initiatives of recent times. So what happens? An intimation under 143. Now, let us say the orders have come and you're not happy with the SSC is not happy, in which case he can make an appeal. So an appeal can be made on an order under 143.3 or 143.1 scrutiny or summary to the commissioner appeals, who is the first appellate authority. Simultaneously, if there is an error in the assessment order, there's a section called 154 where you can make an application for rectification if there is a mistake apparent from the record as far as the order is concerned. So, and you have a time limit of 4 years under 154 to make an application for rectification. Next, what are the issues? The SSC must respond within 30 days for summary assessment. Payment of demand must be made within 30 days, else he has to make an appeal. Return of loss, in the year in which it is incurred, loss return has to be filed. Adjournment of hearings is possible only for genuine reasons and contingencies and not for the sake of delaying the inevitable. In case of online rectification requests, after 2 requests for summary assessment, it is advisable to additionally raise grievance and file rectification if mistake is repeatedly done by Income Tax Department. Avoid filing return of income with tax payable even though it is allowed to circumvent issues subsequently at the time of assessment. Ensure that income and TDS reflecting in 26As are reported in the return of income. If it doesn't belong to the SSC, please seek revision of TDS returns. Because invariably what happens is there could be a wrong PAN which could be used for the purpose of submission by the tax deductor. Such cases you might end up having incomes which are otherwise not yours. So those are circumstances in which your incomes or TDS claims could be exaggerated. So let's look at a few cases, interesting cases. Notice under 143.2 was issued to the SSC prior to filing return of income. The notice was, and the order passed scrutiny assessment on the basis of such notice shall be deemed to be bad in the eyes of law, because as we are aware, for the purpose of issuing a notice under 143.2, return of income has to be filed under 139 or in response to a notice under 142.1. Where a claim of deduction is made under a wrong provision, but necessary facts for said claim were to be set up are available in the return. In such a case, the AO can consider the claim without revised return being filed, because revised return is required only where the AO does not have complete facts for completing his assessment, or the assessee wants to disclose certain other facts. However, if the deduction is wrong, but it can be categorized under certain other provision, then there is no requirement to file a revised return. Next, servers of scrutiny notice on authorized representative of SSA on the ground of non-availability of SSC is deemed service of notice on SSA and sufficient compliance of 143(2). See, what typically happens is where the SSC is not available, is consistently traveling for official or personal or for reasons to avoid collection of notice. The authorized representative collects the notice that is deemed to be adequate service of notice, and the SSC cannot come back and say the notice has not been served to me, and since the time limit under 143(2) is lapsed, you do not have an option to proceed with the assessment under 143(3). Where loss returned by the SSC was reduced on account of disallowance of depreciation and said shifting of depreciation to a later year had no income tax liability, additional tax could not have been imposed by invoking provisions of 143(1)(a). So where your loss is only reduced, there is no reason for the SSC to be demanded of excessive additional tax liability, just that there is a rollover of loss from 1 year to another year. So this, and it only leads to a reduction of loss and not to an increase in taxable income, in which case there is no tax impact as such which is deserved for this particular case. Now let's look at how the situation pans out in other countries. So in US, there is a voluntary self-assessment, which is very similar to what happens in India. However, many large businesses and mid-sized businesses are continuously audited by IRS and state tax authorities. Unlike India, US has both federal and state taxes. The audits may include the entire list of taxes for which the business is liable. Smaller businesses and persons with lower incomes are generally subject to audit on a selective or a random basis. Even in India, what we are given to understand, less than 1% of the returns filed are picked up for scrutiny. Canada, the assessment notice is sent within a reasonable time. Original assessments are usually based on limited review. The notice of assessment will identify any changes made. Revenue Authority targets its resources on high-risk taxpayers with minimal resources spent on low-risk taxpayers. And again, friends, here we need to understand, Income Tax Department in India collects almost 12 lakh crores a year. And out of this 12 lakh crores, our cost of collection is only 10,000 crores, which is less than 1%. So effectively, if you notice, friends, the return on investment as far as Income Tax Department in India is one of the highest in the world, where we have 100-time ROI annually on the expenses incurred by the Income Tax Department. Singapore, the IRAS adopts a risk-based approach to identify compliance risk, with a focus on improving the behavior of taxpayers who pose a risk for higher non-compliance. In Australia, again, it's based on self-assessment. Tax officer undertakes an ongoing compliance activity to ensure corporations are meeting their tax obligations. He or she takes a risk-based approach to compliance and audit activities, with efforts generally focused on taxpayers with a higher likelihood of non-compliance. Compliance activities take various forms, including general risk reviews, questionnaire reviews of specific issues, and audits. UK, the corporation tax is again an online, is one of self-assessment. 12 months for raising formal queries available to the department. The changes can range from simple information to treatments adopted in tax return. There are certain powers to demand information and some circumstances to even enter the premises to obtain documents. So these are ideally the situations prevailing in other countries. So these were some of the thoughts which we thought we shall share as far as this particular topic is concerned, friends. So if you have any questions, be more than welcome. Else, thank you for your participation, and hope to see you again soon on a different webinar in the assessment procedure series. Thank you.